Welcome to Real Estate Hustlers Podcast. I'm your host, Josh Appleman, founder and CEO of Equity Group and Appleman Properties. We're joined today with Tyler Vinson. Tyler is a seasoned real estate investor, has acquired over 85 buildings, and founded Extant to improve investment services. He's a speaker, author, and pioneer in real estate tokenization with REtokens. He excels in multifamily and residential property investments. Tyler, we're excited to have you on the show today. If you could just tell listeners a little bit more about yourself.
Yeah, thanks for having me on. I've been in investment real estate for approximately 22 years. Most of my background is in multifamily, although more recently storage facilities, and I've owned maybe half a dozen or so commercial properties and still own most of those today. So, deal structure, creative finance, syndication, seller financing, acquisitions, property management. That's really all my background and has actually led today where real estate tokenization is a big part of what I do and where I spend my energy.
Yeah, no, and your background in real estate is very, very robust, more than others. And I say that just because of the amount of sides of real estate that you have been on and excelled on and have gained expertise. We were talking a little bit before we went live here about real estate tokenization, and I went down in the rabbit hole on just learning about it and learning how you can trade on blockchain, and essentially it's taking fragmenting real estate so that others can invest in small pieces of it. Is that correct?
Yeah, there's different ways to do it. I mean, recently you've seen headlines with like single family homes being made into NFTs and being sold, and you could get into a real rabbit hole of fractionalized NFTs, which in itself is an oxymoron because NFT stands for non-fungible token. You're not really supposed to break that up. But what we primarily do is deal with the security side of it. So yeah, exactly. We're fractionalizing real estate, and it's not something that's not already done today. Syndicators put projects together and they're really called shares today instead of tokens. But the problem with shares and private equity shares in particular is just try to buy, sell, and trade those private equity shares. There's really no market for it. It's extremely clunky. You're normally have to involve a lot of middlemen to do that, to where when you tokenize the real estate today and digitize the title is really what you're doing, and put it on blockchain. Not only is it immutable, which prevents a lot of fraud potential there, public facing, so everybody can kind of see what's going on in the cap tables, for example, but it allows you to settle those transactions same day. So you could buy, sell, or trade pieces of your real estate that very same day and get liquidity. And there's also lenders out there. I mean, so let's first make a quick distinguishment. Often people group crypto into real estate tokenization, and they're really not the same thing. Crypto outside of Bitcoin is really like startup stocks type comparison, to where these are actual securities. These are real pieces of real estate. So when the buyer buys one of these fractionalized pieces of real estate or a real estate token, they're an actual owner. They get an actual K1, they participate in the actual cash flow, they participate in the upside. And the nice thing for, say, real estate owners or syndicators from a liquidity perspective is really twofold. Number one, your investors that you put into a deal are normally locked in there for 5, 7, 10 years, long periods of time. And it's really difficult to get in and out of those situations. Well, on our platform, for example, there's your cap table there, and the investors can buy, sell, and trade amongst each other and settle instantly, as I said. And then there are secondary markets out there. And as we spoke before we went live here, there's a lot more being developed where people will actually be able to buy, sell, and trade, non-accredited as well, buy, sell, and trade in real time. There's a huge pinup demand for folks that want to buy real estate, but the entry barrier is so high, right? Minimums are typically 50,000 or 100,000, and investors don't want to bring on 1,000 investors because they got to manage that. And imagine sending out 1,000 K1s. But when you put it on the blockchain and digitize the title. All of that's automated and streamlined. So it makes it very easy to manage 1,000 investors. You can build automation into the K1s. And like I said, you can settle the same day. Kind of circling back to what I was talking about in the crypto comparison, you can actually also go leverage those security tokens, those real estate tokens. And here's what I mean. Let's say you needed 100 grand in liquidity to put down on a deal today, but you didn't want to actually sell your real estate or your real estate tokens. Well, that's really difficult to pull equity out of your property right now. You either got to sell it or you got to go to the bank and go through a lending process. And that's if you're a GP and have permission, or you're a sole owner. If you're an LP or a limited partner in there, you can't really do that at all. But when you tokenize the real estate, you can actually put your real estate tokens up for collateral. They'll give you a loan based on that collateral and instantly get your liquidity that same day. And it never jeopardizes the title of the real estate. If you goof up and you don't pay this loan back, they're just going to take your security tokens as collateral. So that allows everybody to be able to leverage their equity. So that's one more avenue for liquidity.
That's huge. That is, yeah, in chain of title, on the blockchain, you see it. You see every trading, every changing of the hands. So there's not, once you get, you don't necessarily have to dig for a clouded title. It's all right there, and it can be audited at any time. And just having, and going into the portal, I think it's getting over the word tokens and trade tokens for shares. And I mean, you're still getting your distributions. There's still a huge learning curve, and I think that once it catches on, more and more people catch on to being comfortable with it. It'll pick up some legs. But
yeah, I try to tell folks, don't get too caught up in blockchain or tokenization or technology or the revolution of it or all of those things. I really approach it from, what are you doing in real estate today, and how can it be solved by digitizing the title or the ownership? Because at the end of the day, that's all you're really doing when you tokenize it, is you're just taking the ownership and putting it in digital form, which allows you these different amenities or benefits that blockchain technology brings in. So whether you're a capital raiser, there's great estate planning strategies. Developers use this. You can create funds and tokenize funds. So whatever you're doing in real estate today, it's much more of just a lever to do it more efficiently and better versus getting caught up in all of the technology jargon and things like that.
And it creates, I think it was going to create a massive amount of liquidity too for syndicators to be able to go and purchase great deals. The syndicators are always looking for more capital to purchase more deals and create returns. And this is just another vehicle that can be leveraged to help take down bigger deals and create other avenues. It's a very cool stuff. Back in 2001, what got you interested in getting into real estate investing?
Yeah, kind of a funny story. My best friend and an investor with me today had come home from college from UW, and he was living in my basement, and he just had come across a real estate investment seminar. Back in those days, there was like, Russ Whitney, Carlton Sheets, and Robert Allen was about the only guys out there. And this one happened to be a Russ Whitney type event. So we went to it as just kind of an evening thing where they were upselling a weekend program. And once it was finished, I was like, okay, let's just go have a beer. And he's like, no, let's do it. And I was like, man, I'd have to call in sick for work. I don't know. Long story short, he talked me into it. We did the 3-day seminar. It was really poorly done. I'm huge on education. I've made my career traveling the country and learning, but this was not that. This was not very good. And at the end of it, we just said, let's go buy some real estate. And so we went out that year and made different connections, real estate attorneys and brokers and CPAs, and started buying a couple duplexes.
Nice. So the 85 buildings that you've purchased throughout your career, what are some of the strategies that you've used?
Well, I'll just talk about my favorite strategy, and it's a strategy that I often use today. And a lot of listeners might like this because it really is a no money, no credit type strategy. But as you've heard many times, no money doesn't mean there's no money. It just means it's none of your money typically involved. But I work with a lot of private investors. So one of my kind of hallmark deal structures is I do a lot in owner finance. In fact, I've written a book. That's the book I wrote, has a lot to do with owner financing and some of the benefits in there. And so what I would do is I would find properties that were not operating at their highest and best use, and I would contact the owner directly. And we can get into some of the details of how I did this if you want, but I'll give you the high level first. So I just contact the owner directly, and I'd had quite a bit of training. I just mentioned I was big on education and traveling around to do that. I had quite a bit of training in the seller finance world and promissory notes. So I would negotiate, nice seller financing terms, and then I would work with private investors to bring in the down payment, any fix up costs. Of course, an acquisition or commission up front as well. You always want to get that in there, as well as a reserve. And so that's what I mean by no money in. It was none of my money. I always knew what my investors needed for a return. And so I would structure the deals based on that. And I would say that's, if you're just kind of getting started, I think that's one of the big mistakes that people make, is they're always out there just looking for deals. And you've got some of the gurus out there that'll teach, well, if you find a good enough deal, you'll be able to find the money.
Yeah.
And although that may be true, how many times have you heard of people being under contract and running towards the finish line and they don't have all the funding they need, or they put a deal together and they're not coming up with the funds that they needed, so they're having to pay a lot more for those funds than they originally wanted to, or maybe they're not even sure the best price to negotiate the deal at because they don't know how much their money costs. So it would be my recommendation that you put as much effort into finding the deals and the acquisitions as you do into building your private investor list, and that you approach those private investors. I had a program that I used, and I would always approach those private investors prior to having a deal available for them. In fact, there's securities law involved in that too, that there's reasons that makes sense. But often private investors will say no to the very first deal that you offer them. So I would use a strategy like this, and this is how I'm a capital raiser for sure, and this was one of my primary strategies. So I had a very small list in the beginning, like one or two, and I'd go put a deal together, and I normally had the one that would probably take it, but I would put a package together and pitch it to the second, or let's say I have a list of 5 only. And I would do this if you have a list of 100 as well. You're just going to do it in a bigger format. But I would put the list together, and different investors fit different profiles of the investment. But I would put it together, and the first investor would always take it, but I would pitch it to everybody down the line and say, hey, look, here's the type of investment, I'm buying this, this may be available for you. Here's the projected returns. Here's, you could call it a pitch deck, if you will, or I used to call it an investment package. And I would put that in front of them, and I would say, hey, I do have another investor that I've been talking to for quite a while that I promised, a deal first in line. But if the timing doesn't work for them, because the deal's always good enough, right? I mean, you don't want to put together bad deals. So I would say if the timing's not right for them, or they're not able to do it for some reason, then I'll ask you if you want to participate in the deal. Well, of course, the investor would always take it. So I would call the private investors after that and say, hey, no surprise, the investor took that deal. It's a great deal. But would you like to be moved up to the top of the list? Are you ready? If you see something like this coming down, is this something you're ready to say yes to? And of course, once that takeaway clause is there, they were pretty darn eager to get into the next deals. And so every time I would go in and structure my deals, I always knew what my cost of money was. So it gave me confidence when I was negotiating these deals. I could quickly assess what the returns would be and how much money I needed to pay my investors, how much money I would make, and then of course, the terms of the deal that I would negotiate.
Huge. You work the deal backwards, and that way you know your good, better, and best scenarios. I totally agree with you on the money doesn't necessarily follow the deals. It's the deals. If the deals make sense, all right, who's the jockey? Who's the one that's in control of this deal, and what is their experience? And then who's around them to make sure that their experience is fully intact too. It's the operators, the guys that are running, going to make sure the deal goes full cycle and it's a success. Especially investors want to invest in the people. The deal is great, deal works out, of course, but it's more the person's experience that's running the deal, and it's a celebration. Everyone wants to celebrate the wins, and you want to make sure that that goes all the way through to the end of the cycle of the deal. But totally agree with you.
Yeah, well, and that lines it up to where the money's chasing you versus you chasing the money, and there's a big price difference between those two scenarios and 100%. What you pay for the money.
100%. Back in 2009, what was your biggest takeaways, and what did you take out of 2009? That the whole recession and with real estate.
Yeah, in a nutshell, it was don't be over leveraged and be careful what the gurus teach you and tell you. Yeah, I got decimated pretty good starting in summer of 2008. I'll actually never forget that hot summer day. I walked out of a real estate continuing education class, got a call from my lender. And, because I was doing acquisitions as well as some brokerage activity at the time representing investors. And he said, Ty, none of your deals are going to close. And I said, well, what do you mean? Do we need like extensions? And he said, no, they're not going to close at all. The banks can't lend. And I won't go into the big, long story unless you want me to. But the long and the short of it is I wasn't super far down my career at that point, but I had about maybe 10 houses, and half of them went vacant within a 30-day period. And because I was doing lease options with them, I had rented them at a little bit higher rental amount, which was fantastic. But what the gurus were teaching back then was, and the market was going up so fast, you probably saw a lot of this last year as well, where you would purchase a property. Not too far down the road, you'd have a nice equity position. So you go get an equity line of credit and use it as a down payment on your next property, rinse and repeat. That's a very dangerous strategy if the market takes a turn to the downside. You can play that game when the market's going up and up and interest rates are staying low. But similar to the environment we're in now, and people are going to face these hard facts, when interest rates are going up and the market's going down, that doesn't work so well. And the bank actually couldn't lend. So they took my credit lines down to the balances. So not only did that destroy my reserve, at the time I used a lot of credit for reserve, and I definitely recommend cash for reserve. So that not only ate that up, but it destroyed my credit scores, and I couldn't get new loans. And it was a pretty ugly time frame, kind of holding on by the skin of my teeth there. So I learned about leverage very significantly, and leverage is your best friend. It's what's given me the portfolio that I have today in financial freedom. But done wrong, it is by far your worst enemy, and the way you lose is the wrong kind of leverage. If you don't have low interest fixed financing for a long period of time on your properties, you're risking that. The last 2 years, I talk to people all the time in the apartment world doing all these bridge loans and basing it on cash out refis or resales. Oh, and rates will never go up. They may go up to 4.5. They'll never go up over that. And there is a lot of pain here and coming due to those folks having short-term financing and not solid plan Bs, or even worse, short-term financing on long-term hold projects. They're losing them when that's the case. So financing is a powerful tool. I always say there's two parts of every deal. One's the brick and mortar, the other is the financing. But if you don't do it right, and you're not prepared for changes in the market, it can bring a lot of pain. So that's my biggest takeaway from back then.
Yeah, that's incredible. Just some of the nuggets that the listeners can take away from that of because it can happen quick. Market goes up, you've got equity, you use that equity to buy another. And I think it all goes back to buy for cash flow and make sure that you've got ample cash flow to service the debt as well and multiple streams of income. But in any if anything gets bad enough, things get squeezed on all fronts because ultimately people are you're trading with people. It's people to people. So if people are losing their jobs, and then that's a trickle down effect to multiple other things where maybe your other streams of income get squeezed as well. But great takeaways for sure.
Yeah, well, and that led me to the model that I explained earlier with all the seller financing, because there was a period of time based on what happened where I probably couldn't have financed an outhouse. But people still knew me, liked me, and trusted me, and I still knew what I was doing and believed in real estate. So I would do, because when you're dealing with banks, they're very rigid. They're not flexible. If stuff hits the fan, that's the way it goes. But if you're working with people, you're kind of in that together. So not only is it easier to kind of write your own rules to that, and I very much do that when I structure these notes, but if something were to go wrong or you need to negotiate something, there's a person that has a mutual interest in there too. So it's really a great way to diversify some of that risk. And the market here in 2023, 2024, and potentially beyond, seller financing is going to be a huge tool because guess what? People using bank loans are borrowing at what, roughly 7% today. Well, if you can go get a seller note at 5, which is still a good win-win, they save on taxes and stuff like that. How much more can you pay for the property than the bank buyer guy, right? Think of those type of strategies going into the next couple of years and be able to set yourself up, like you said, a lot more predictably.
Yeah, no, I totally like that. If you could just let us know the importance or discuss the importance of networking, mentorship, and in your journey of how it's contributed to your success.
Yeah, it's really everything. I mean, that's gonna make you who you are as an investor and a real estate investor. I've had some fantastic mentors in my life, and I didn't find them in my own hometown. I had to fly to different events and pay a lot of money in a lot of cases to study under some folks. And not all folks are created equal. So make sure you get a lot of references before you really, buy into somebody's mentoring program. Look at their track record, right? What type of deals not only have they done, but what are they doing and who do they know? Because you can get access to world-class folks, and that's where you want to be. So the mentoring's been huge. They give you the confidence as well as the education. And I was the type, I'd go to some of these events and, I was there 5 minutes early and I was there at the end. I'd even listen and overhear where they were going to dinner that night and happened to show up, see if there was an extra seat. So I would develop personal relationships with some of those mentors and get to know them, because I want to know what type of CPA are you using? Why? What type of attorney? Why? How are you structuring your deals? Why are you doing it that way? What's going on there? And then as far as your network goes, that's where you're really going to be able to build your private investor list as well as your acquisition list. If you're going to start investing outside of your local area, it's going to be critical that you have a strong network so you're not guessing at which property management company to use. People in the area. So doing certain events will help build that network, but it really, I guess what's a cliche, your net worth is equal to your network. I'm not sure if that ratio is perfect, but it is a huge influence for sure.
Yeah, I didn't even have a formal email list builder until let's say a couple of years ago, because I never really I'm not going to say I didn't need it. I've always kind of just had it outlook there, just going through it, but not an actual a CRM for just your network. And it's amazing how people can connect you with other people on just simple things, because everyone's providing some sort of service. And if you've just got an organized CRM with some tags, you can help other people who might be looking for someone that does something else on an expert level. And that goes in a network. It's huge.
Definitely.
So on the tokenization front, you've created this company. are you all actively taking investments in and helping connect investors with real estate tokenization?
So what we're focused on right now is bringing real estate assets on chain. So because for investors to be able to buy these real estate securities or these real estate tokens and to kind of level that playing field, which is the ultimate goal, you need to have enough assets on chain, quality assets, for them to be able to buy, to create these marketplaces. And that just really doesn't exist today. So the position we've taken is to really try to lower the entry barrier to tokenization. In the past, it's been very expensive and complicated to tokenize your real estate. So unless you had maybe a $10 million asset or more, you wouldn't really do it. That's what you've seen over the last couple of years. But we want the majority of real estate investors to be able to take advantage of it. So we've built our model around a low cost entry barrier to be able to take your asset or to create a fund and tokenize that and get it on chain. Because yeah, once it's on chain, then you can start taking advantage of that huge buyer demand, as well as a lot of other amenities that come with digitizing that title.
Perfect. That's perfect. Got it. For somebody who's looking to get started in real estate, how would you recommend that they first get started on their path forward?
Yeah, I think that most seasoned real estate investors will tell you that they are relentless educators, that they are educating themselves. I educate myself on a daily basis and going and learning from people that are doing it in the spaces that you're interested in. And that's not just the folks out there selling education. Pay your local real estate attorney that does wrap contracts and closes seller finance deals. Pay them for a couple of hours of their time. Go visit multiple CPAs that specialize in real estate and understand that, because you want to know how the seller is thinking and what's important to them, as well as the investor. How do you protect them properly? What's the type of deal structure for that? So those are some of the nuts and bolts that people don't talk about, that don't have a huge timeline learning curve. You can go do that in the next 30 days. Set up a couple of attorney appointments. And again, make sure they're the right type of attorneys. Back to the network, right? You need to get some referrals of folks that actually close those type of deals, but you can pay them, a few $100 or $500, whatever their hourly rate is. And that's much cheaper than taking, 3-4 days and flying somewhere and going to a hotel, although that's fun too. But that would be one thing, is the education, right? There's lists of books out there that are very often recommended, and we can talk about that too. But I would start there with the education. From there, you need to decide what type of asset you're going to buy, how you're going to start, and just focus on that first deal or two. One of the biggest mistakes I see people make is say, oh, I want to quit my job in 6 months, replace my total income. I go, how much do you make a year? Oh, I make, 60 grand a year. Okay, well, then you need to go look at about a $10 million apartment building. You probably need to raise $3 or $4 million. Do you have the ability to go do that right now? Or they're like, well, I looked at this commercial building and I looked at, this single family home, and I looked at, buying part of a farm. You need to decide on your first deal. That's what you need, is you need to gain momentum. So what do you want to do first? Is it a house? Is it a duplex? Is it a small apartment? And focus on that, because you need to learn that piece of the puzzle, that asset class first. You need to speak about it intelligently to potential investors. You need to understand the value, the market of it. Real estate's very regional, and even asset classes are different. So decide what that deal is. You may have huge aspirations, but get your first deal or two done. And now you have a story. You have a story to tell sellers. You have a story to tell investors. Brokers now that were involved in your deal, or whoever, or other investors, wholesalers, whoever was involved in that. Now you have something, a little bit of foundation built to do that. And then the other thing we spoke about earlier was come up with a private investment program. And if you haven't borrowed private money before, and the way I got started with this is I just built myself what I called a credibility kit, almost like a little resume kit. And I didn't have a bunch of experience, right? Very easy now. In fact, I've got a huge list of investors. I always have more capital than I have deals, right? So I would love to have more deals. But that's because I would put this credibility kit out together, and I would go network and meet people and tell them, hey, yeah, no, I've been I'm going to invest in real estate. Not that I want to, not that I'm hoping to. I'm going to invest in real estate. These are the type of assets I'm buying, right? Back to that thing of knowing your asset. And here's why I think I know I'll be successful. If you don't have experience, you're going to need to list on there maybe who's around you. Who's your team? We know that's huge, right? Oh yeah, this is a property management company that I'm going to use. They're solid. This is why I like them. Hey, these are, one of my mentors. We talked about mentorship. This is what I'm studying. This is what I've done. These are the type of deals I'm looking at, and even have real case study deals of things you're looking at. And so you can talk intelligently about that. And you're not asking for money those first couple times you meet with them or talk with them, right? But as soon as you get that one deal under contract, believe me, pitch it to all of them, even if you already know somebody that has that. And I do recommend the seller financing route because it's really, in my opinion, the cheapest, easiest money out there. And if you're going to work with private investors, that's a much easier thing to do. Let's say you're buying a $500,000 duplex or triplex, right? If you got to come up with 500 plus acquisition, plus reserve, plus all that, you're either going to need to get a bank involved or you've got to have an investor invest quite a bit of money. But if you go out there and that same $500,000 duplex, you only have to put, 50, 60, 100 grand down, and you structure that deal. Now it's much easier to get $100,000 or $150,000 from an investor on a $500,000 asset. So those are some of the stepping stones I think that have a good chance of being successful early on.
That is phenomenal advice and great guidance for sure. Is concentrating on your buy box in your first deal and getting it on base. If somebody wants to learn more about you and get a hold of you and possibly do deals with you, please keep your contact information.
Yeah, so I'm on LinkedIn. You just search Tyler Vinson on the LinkedIn. My two websites, my private equity company, like if you want to do joint venture on deals or sell deals to us, would be extantinvestment.com. It's EXTANT investment.com. And then if they're interested in the tokenization, it's just REtokens.com.
Awesome. Perfect. I appreciate your time and look forward to talking to you here soon.
Sounds good. Thanks.
All right. Thanks again. Bye.